and welcome to Prime Property, your weekly real estate reckoner. I'm Nayanthara Rai and this is what we have on the show today. Achhe din aane wale hain. Neglected year after year, the battered realty sector is finally looking at a new lease of life from Finance Minister Arun Jaitley. From a higher tax rebate on home loans to a simplified FDI regime to interest subvention for affordable housing, the Finance Minister has laid the foundation stone of Narendra Modi's vision of 100 smart satellite cities. But the biggest announcement for the property market is the introduction of real estate investment trusts or REITs. The devil is in the detail though. Industry says the introduction of REITs has been dampened by the levy of a dividend distribution tax. And the country's largest developer DLF explains the impact of this budget on the property market.
I rise to present the budget for the year 2014-15. The country is in no mood to suffer unemployment. The Prime Minister has a vision of developing 100 smart cities. I have provided a sum of rupees 7,060 crores in the current fiscal. As an innovation, a modified REITs type structure for infrastructure projects is also being announced as Infrastructure Investment Trust. I propose to increase the allocation for 2014-15 to 8,000 crores for National Housing Banking Program with a view to expand and continue to support rural housing in the country. The government is committed to an endeavor to have housing for all by 2022. For this purpose, I intend to extend the additional tax incentive on housing loans to encourage people, especially the young, to own their houses. I propose to allocate this a sum of rupees 4,000 crores for the National Housing Bank in view to increase the flow of cheaper credit and affordable housing for the urban poor. Requirement of the built-up area of capital conditions for FDI is being reduced from 50,000 square meters to 20,000 square meters and from $10 million to $5 respectively with a 3-year post-completion lock-in. Madam Speaker, with these words, I commend the bill to this House.
That's the Finance Minister laying down building blocks for the real estate sector. For an industry neglected budget after budget, Arun Jaitley's words have overnight opened new avenues for the realty sector that has been battered out of shape since the Lehman crisis. Manasi Gilani tells you why the real estate sector is also saying, "Achhe din aane wale hain."
The maiden budget of Modi government has ensured that many of the bottlenecks for real estate sector are addressed. The budget has come to the rescue of real estate from all quarters, whether it is tax incentives for homeowners or tax clarity for developers looking to monetize assets using REITs, or impetus to the affordable housing. Finance Minister Arun Jaitley had laid down the foundation of Prime Minister Modi's 100 smart cities as well.
To provide the necessary focus to this critical activity, I have provided a sum of rupees 7,060 crores in the current fiscal.
That's not all. The Finance Minister also ensured that affordable housing gets a start, with a 4,000 crore initial allocation.
I propose to allocate a sum of rupees 4,000 crores for the National Housing Bank in view to increase the flow of cheaper credit and affordable housing for the urban poor, economically weaker section LIG segment.
The Finance Ministry will also increase allocation to Rural Housing Fund, which will be monitored by National Housing Bank.
I propose to increase the allocation for 2014-15 to 8,000 crores for National Housing Banking Program with a view to expand and continue to support rural housing in the country.
And as Prime Property told you first, the budget has provided tax ops to real estate investment trusts or REITs to ensure their successful launch. This has also been complemented with a liberalized FDI regime. So just like we told you, the minimum built-up area norm has now been halved to 20,000 square meters and the minimum capitalization norm has been halved to $5 billion.
I intend to introduce to provide necessary incentives for REITs which will have a pass-through for the purposes of taxation. As an innovation, a modified REITs type structure for infrastructure projects is also being announced as Infrastructure Investment Trust, which would have a similar pass-through status for PPP and other infrastructure projects. These structures would reduce the pressure on the banking system while making available fresh equity.
There's about 100 million square feet of offices that are available to be REITed out. That, approximately value will be between 50 to 60,000 crores. I can easily say that there could be between $5 to $7 billion of private equity that may want to come in, with the threshold of 50,000 square meters being reduced to 20,000 square meters. That itself is another 35,000 crores. So just these two initiatives you were to put in, it's closer to 85,000 crores.
Jaitley announced some key measures to provide impetus to the infrastructure that is the paramount importance to the real estate sector. The budget has allocated a total sum of 37,880 crore towards NHAI for construction of highways and additional 3,000 crore to boost the road connectivity in the northeast regions. It targets 8,500 kilometers in the current financial year. And though this is integral to connectivity, experts argue even if half of the target is met, it will be a big achievement. Ahmedabad and Lucknow have been singled out as special beneficiaries of this budget, with allocation of 100 crore towards deployment of metro rail systems in these cities. The increased connectivity will raise the scope of real estate development there and also have an impact on property valuations over the mid and long term. The development of 16 new ports has been proposed to an outlay of 11,000 crore. Additionally, an allocation of 11,600 crore has been made for the development of Outer Harbour Port project. The combined effect of these provisions will be that there will be an increase in demand for commercial office space from the manufacturing sector in India's major port cities. And while focusing on areas at the macro level, the finance minister has not forgotten the Aam Janata. Income tax deduction for interest on housing loans that has been raised from 2 lakh from earlier 1.5 lakh has been welcomed by the housing finance companies. Experts say that this will only further promote home buying amongst common man. But it's the review on SEZ policy that will be keenly watched by the industry.
He talks about bringing back the special economic zone, but he doesn't talk about the tax relief which is needed to analogous to bring about the emphasis on special economic zone. So we'll have to see what further clarifications and things come into those sectors and read actually the details of the budget in order to understand that. I would rate it at 7 because the expectations of the budget were very, very, very high. So I think he's lost out in terms of giving a higher expectation.
Taxpayers may have expected more, but with just 45 days into the business, majority in the real estate business believe Jaitley has done a fair job, which only means that the key measures required to boost the sector will now be taken care of, and the sector is headed in the right direction once again after a real long wait. In Mumbai, Anasi Gilani.
Real estate investment trusts, or REITs, have the potential to change the landscape of the real estate sector. Think of REITs as listed units of a mutual fund, where the underlying ownership is in a commercial or a rent-yielding retail property. The rental income of the assets owned by the REIT is distributed as dividend to its investors. Not only is this expected to attract billions of dollars to a cash-tight sector, it will also provide an alternative low entry point for retail investors to invest in real estate. I reached out to EY to understand the proposed REIT structure, tax swaps that have been offered in this budget's fine print, and if it's indeed a lucrative option for retail investors.
So from a retail investor perspective, there are 2 or 3 advantages. It gives the retail investor an additional product for a fixed income kind of investment. Right now there are only fixed deposits which give you a return. An investment in a REIT would similarly give you a very stable return. It would be low risk because the REIT owns completed assets which are rent generating, so there is no risk in terms of development or approvals or stuff like that. So it would give you stable returns, it would be low risk. It would also hedge you against inflation, because real estate, as we all know, is a natural hedge against inflation. So it would hedge you against inflation, and it would also give you capital appreciation if you are a long-term investor. Because when the REIT disposes the asset, there would be a capital gains, because real estate, as we see in India, India as a market, real estate only appreciates commercial real estate.
And Madhav, how has a retail investor been defined with respect to REITs?
So the minimum subscription size is 2 lakhs and the minimum trading lot is 1 lakh. So they're not looking at really retail investors. SEBI is not looking at pushing this down to the absolute small investor, but they're looking at slightly more sophisticated investors in terms of retail investors.
Now, Madhav, what is also going to determine the success of REITs in India is going to be the tax structure. I understand the pass-through tax status announced by the finance minister in the fine print is different if the REIT directly owns the realty assets from instances of REITs owning the realty assets via SPVs. Can you please explain us the difference between these two cases with the help of an example?
Okay, sure. So let's look at an example where the REITs directly own assets first. We'll come to the SPV structure later. Where the REIT directly owns an asset and gets a rental income of, let's say, 100 rupees. This would ideally be taxed as income from house property. So there would be a 30% deduction which would be available. So the balance 70 rupees would be subject to tax at the maximum marginal rate, which is 30%. So 70 rupees, 30% would be another 20 rupees of tax. So from a cash flow perspective, the REIT would have 100 minus 20, which is 80 rupees. And the REIT could distribute this 80 rupees to its investors as dividend. And this should be exempt in the hands of the investors. There should also not be any distribution tax in the hands of the REIT when the REIT distributes this 80 rupees. Now, if we put the same example, the same numbers in a SPV structure, there would be a difference. So the SPV earns 100 rupees of income. Again, this would be taxed as income from house property, so there would be a 30% deduction available. So 70 rupees would be subject to tax. The tax would be again at 30%, 20 rupees of tax. So that leaves a cash of 80 rupees at the SPV level. But now when the SPV distributes this 80 rupees to the REIT, there would be a dividend distribution tax leviable on the SPV. So you would have a 17% dividend distribution tax on the SPV. And the finance minister has changed the method of calculation of dividend distribution tax. So the effective rate of dividend distribution of tax has gone up to close to 20%. So on 70 rupees, if we take an effective rate of 20%, it comes to 14 rupees of dividend distribution tax, which means the balance 56 rupees gets distributed to the REIT as dividend, and the REIT further distributes the 56 rupees to the investors. When the REIT receives the income, there is no tax. When the REIT distributes this 56 rupees, again there is no dividend distribution tax, and in the hands of the investors as well, there is no tax. So the effective rate here comes to 20 of corporate tax plus another 14 of dividend distribution tax, which is 34 rupees. Vis-a-vis in the earlier example where the REIT directly owned assets, the effective tax rate was approximately 20%. So you see the dividend distribution tax makes a difference over there.
So from that example, it's pretty clear it's not going to be very tax efficient to invest in REITs that own realty assets via SPVs. And from what all you're telling me, wouldn't an HNI prefer to buy a real estate asset and not necessarily buy into REITs?
An investor directly owning the real estate would be better off from a tax perspective than owning it through the REIT. So it's necessary to bring about that change in order to bring that parity.
So it's clear there are serious concerns arising out of the levy of that dividend distribution tax. Besides that, various experts are saying the REIT structure needs improvement. What are the other problems that the industry has?
Currently, the tax proposals provide for a tax deferral when the sponsor transfers the shares of an SPV. So the SPV holding the real estate, the sponsor transfers the shares of that SPV to the REIT. And in consideration of that transfer, the sponsor gets units of the REIT. So there is a tax deferral. There is no tax in the hands of the sponsor at this stage. In future, when the sponsor sells the units of the REIT, there will be a tax. A similar deferral should be provided. When the sponsor contributes the asset directly to the REIT instead of transferring the shares of the SPV. Now, the second thing, of course, is a clarification that foreign direct investment and foreign portfolio investment should be allowed into REITs so that we can have global institutional money flowing into Indian businesses and the Indian economy. So that's really number two. Number three, which is a change required both from the tax authorities as well as SEBI, is that REITs should be also allowed to invest in partnerships which hold the property. Right now, the format just envisages private limited companies or companies in which the REIT can invest through holding shares. So they should also allow the REITs to invest in a partnership, because that will again give more flexibility and it will help in saving dividend distribution taxes. The fourth thing is, currently the way the fine print is, For a REIT unit to qualify as a long-term capital asset, the period of holding has to be more than 36 months. This should be brought down to 12 months because they should be treated on par with listed equity shares. So listed equity shares are given long-term treatment once they are held for more than 12 months.
I'm guessing these are all the issues that industry will be raising with the finance minister. But the REIT structure as it stands now, how different is it from the mature markets of the United States, Singapore and Hong Kong?
The tax regime for REITs in mature markets is again a one-time taxation. The only difference is in those markets, the taxation happens at the investor level finally, and not in the chain of the REITs. The only additional piece of tax under the Indian tax regime which has been proposed is the dividend distribution tax. So that's really the difference, or the additional tax which is there in the Indian tax proposals if we compare it to the global tax regime for REITs.
All in all, while industry welcomes REITs, it's hoping the final notification will make it a better prospect by exempting that dividend distribution tax. On that note, we're going to slip into a short break. On the other side, the GLF CFO tells us what the impact of the budget is on the country's largest developer and the property market at large. Stay tuned.